Good afternoon, everybody, and welcome to another episode of the Tip Share. Today, we are going to be going over a basic understanding of how to read your profit and loss statement. Many operators don't have a full understanding of how to read their P&L. In fact, many don't even have a basic understanding of where the data is coming from. Furthermore, how to interpret the data into actionable insights. It's critical for the financial health of all restaurants that those who are making scheduling decisions, buying decisions, and any other major business decisions fully comprehend how to read an income statement. It's even more important that you can utilize the knowledge behind what goes into the P&L. Throughout this deck today, we're going to cover the following. We'll create an understanding around sales calculations. We'll discuss how to read and understand your P&L. We'll review best practices to maximize your profit. And we'll discuss how to get your management team engaged with your financial statements. First, let's break down the difference between gross sales and net sales. We're going to start with gross sales because this is probably the simplest to understand. Gross sales is the entirety of all of your sales, including sales tax, comps, and discounts. The P&L is based off of adjusted net sales or gross minus sales tax. Even though the customer has to pay sales tax, that is a pass-through expense which you collect from the customer and pay to the state. When thinking about expenses such as labor, you don't want to calculate the cost based off the taxes that have been collected and will be paid back out, but you do want to factor in sales that have been comped or discounted. Calculating and analyzing the P&L based on net sales helps give a true analysis of how you are executing based on full sales. This brings us to true net, which is gross sales minus sales tax minus comps and discounts. This is the most commonly used for restaurants that need proof of sales for their lease contracts. Maybe your rent is based on a percentage of sales, or once you reach a breaking point of sales, additional rent kicks in. Master sales departments refer to the different categories you have set up to categorize your sales. These categories could include any beverages, wine, draft beer, bottle beer, food, etc. The answer to how granular you should get depends heavily upon your concept. There's not a one-size-fits-all. If NA Bev makes up 5% of your revenue, do you need to have a category for teas, coffees, and other? Probably not. But if you're a coffee place and that makes up 80% of your revenue, you definitely want the ability to analyze your costs separately. When creating your MSD category, ask yourself, is there value in separating these out? On your P&L, most of your revenue will reside at the top, so that when evaluating costs as a percent of sales, you have a solid sales basis to divide them into. However, there are some examples of income to the restaurant that you may want to live all the way at the bottom of your P&L and not be included in the sales basis. The most common example of this is when a restaurant sells retail, such as t-shirts or hats. This is a great business activity, but does not normally make up a large amount of your revenue. Also, when you're evaluating your operational labor, retail sales should probably not factor in. You don't want to analyze and write a server schedule based on how much in retail sales you think you'll be selling. Other income should live at the bottom of your P&L and should be separated out. Okay, so what we're going to do to simplify your P&L is we're going to pretend that all your sales equal one single dollar. This is a great way to reinforce why evaluating expenses as a percentage of your sales matters. So as we go through an example of the P&L today, think of your sales equaling 100% or $1, and think of your cost percent as pennies taken away from that dollar. So let's see how far that dollar goes. We'll begin with cost of sales, or COGS, and that's the first prime cost area on your profit and loss. In the example shown here, there's a food cost category with GLs that make up those expenses, and then you'll see your pour cost broken down as well. Then at the bottom, you'll see the combination of both cost categories to determine your overall total cost of sales. If the total cost of sales is 26.97%, then based off of the $1 of sales revenue, we spent 27 cents. So how much of that dollar is left? 73 cents remains. Let's quickly discuss what should be reflected in either food cost and your pour cost. One of the questions we get the most commonly is if NA beverage should be part of your food cost or your pour cost. The answer may differ depending upon your concept. If you're a bar and a heavy percentage of your sales are coming from the bar, then it could make sense to have this be part of your pour cost. If you're a full service restaurant with a high percent of food sales and NA beverage sales, then I'd probably default to having this be part of your food cost. Cost basis should always be sales department to cost department, so your NA beverage cost will be based off of your NA beverage sales. And what we mean when we say that your cost basis should be part of your sales basis, food cost should be part of food sales, pour cost, pour sales, etc. So remember that there are many other items that might impact your beverage cost, as they're ingredients for your mixed bev drinks that are considered bar consumables. These items should be accounted for in your overall pour cost and not your food cost. These are items like lemons, limes, oranges, mixers, anything that's being used in your alcoholic drinks. Since bar consumables are needed for liquor drinks, this line item would be calculated on the cost basis of your total liquor sales. Now let's jump to the category that is the largest impact to your bottom line profit. I'm sure you guessed it, your labor. Labor is the largest expense for most restaurants. The first breakout is your operational labor. Think of your operational labor as the labor expense that restaurant managers have the most control over. This is your hourly labor. You can impact this through your scheduling and cutting. The better the manager, the better they are at staffing appropriately for what their sales are going to be. The rest of your labor should include salaries, payroll taxes, employee benefits, and employee discounts. All this combined is the next benchmark to look at, your total labor. So here your total labor is 36.85%. So now how much is left of our dollar? 36 cents remains. Let's review a few other labor considerations. The question comes up often if bonuses should be part of a fully burdened labor or if it should be expensed below net operating income or NOI. The industry standard is to calculate this below the NOI. Typically, incentives and bonus plans are paid out based off of hitting targeted cost goals. One of those areas being labor. If they hit a bonus, that could negatively impact their next period labor goals if this is being accounted for in labor. Hitting bonuses should not impact whether they hit the next period cost goal. Employee-related discounts. Typically, you should have all employee meal discounts hit your fully burdened labor, since in all reality, this is considered an employee benefit and part of their benefits package, which is considered a labor expense. Now that we've accounted for the two largest expenses, this is a great place to pause and see how your profit is holding up. This is often called gross profit after prime costs. Your prime costs are labor and COGS, so this is your profit only considering those expenses. This is a great stopping point to evaluate your operator's overall control of the expenses that they have the most direct control over. Many restaurants we work with set up bonus structures based on gross profit. Moving down the P&L, we're going to look at our direct operating costs. And our direct operating costs is one of the main areas that managers do have the most control over on their semi-variable and fixed expenses. This is where you see all your supply purchases, linen, chemicals, miscellaneous expenses that all need to be managed along with the rest of the prime cost daily and weekly. These line items should also be budgeted along with your cost of sales as they're often purchased with cost of goods vendors. Total direct operating expenses in this example was 3.56%. So if we go back to the breakdown of our dollar, we spent 4 cents. So now you can see we've only got 32 cents remaining left of our dollar. There's one more major cost category that operators can still have an impact on, which brings us to advertising and promo expenses. If we go back to how we discussed net sales, you'll remember that the sales at the top of the P&L should include comps and discounts, which means that somewhere we have to account for those expenses. These are accounted for in your advertising and promo expenses. Manager repairs are for the things that could have a negative impact on the guest experience, where VIP promo are for items that drive revenue. All in all, the total advertising expense in our example is 4.87%. So 27 cents remains from our dollar. Let's talk about some considerations for advertising and promo expenses. First, we've got third-party delivery fees that factor into advertising. These third-party vendors are used to drive revenue by getting your brand out to off-premise diners and increase incremental sales, which is why they fall into this category. All non-employee related comps and discounts fall into this category. This goes back into net sales and needing prime cost to have the credit of 100% of your sales. However, you do have to back that out of the comp expense. Since typically comps and discounts are applied to drive business, this is where those other comps will hit. And lastly, when setting up advertising and direct marketing spend, keep in mind that third parties and comps will factor into this category. It's important that you budget direct spend advertising dollars because this will always be an essential expense to drive top-line sales. Let's dive into our remaining fixed expenses. Your remaining categories are general and admin, such as accounting fees, cash over short, and bad debt. This is 4.45%, so 23 cents on our dollar remains. Next, we've got repair and maintenance, which includes preventative maintenance, restaurant maintenance, and building maintenance. This is 0.58%, so we still have 23 cents remaining. And lastly, we have our occupancy, which includes rent, utilities, cable, internet, water, and sewer. This expense came in at 8.05%, which brings us to 15 cents remaining from our dollar. Now this 15 cents is the NOI, or net operating income. This is the total income prior to non-operating expenses. Keep in mind that prime costs will typically range between 60 and 70 cents of your dollar, and fixed variable expenses will range between 20 to 25 cents. After all those fixed and semi-variable cost categories are accounted for, this leaves us with our net operating income, our NOI. This is our net profit after all costs have been reflected before other miscellaneous income and expenses are considered. Some would consider this their EBITDA. However, don't consider this as direct cash to the bank because there are still more income and cost categories to account for prior to knowing your true net profit. So what else factors into your total profit? There could be some miscellaneous income that's assisting with an increase in your bottom line profit. Some examples of this could be retail and merch sales, service charge income, or room rent income. You'll also have other expenses. Remember earlier we spoke about bonuses. This is where these would hit, along with owner-related expenses like owner comps, salaries, interest expenses, and this is also where you're going to take a hit on amortization and depreciation adjustments that are typically adjusted when you do your year-end taxes. So going back to our breakdown of $1, we've used about 10% of our dollar, which is 10 cents. Now the total amount remaining after all income and expenses are accounted for is our net profit. Out of the $1 we had in sales, 5 cents remains as our net profit to the bottom line, which equals 5%. Now let's discuss some best practices for profit and loss management. The more frequently you're reviewing your financial statements, the better. Managers should be meeting weekly to review weekly P&Ls. This is especially important for the restaurant industry because things change on a dime. Commodity prices, staffing challenges, and consumer behavior. You need to be able to pivot to all of those and adjust your operational practices accordingly. Our next best practice is our manager involvement. The more you involve your management team, the better. Task your managers to compile information and present it to your team and rotate the responsibility to different managers. The more they're responsible for presenting the information, the better they'll understand it, and most importantly, it'll help them be solution-oriented as well. Best practice number 3, our budgeting. So during the breakdown today, we always showed you budgeted and actual information, and that was deliberate. Working off of a budget is critical so that everyone knows where to aim and is aligned on what the goals are. A 30% food cost would be good for some restaurants and poor for others. So make sure everyone on your team knows where you want them to fall in terms of financial results. Lastly, cash management. Proper cash management adherence is key to a complete and accurate financial statement. An audit should be completed in cash management to match off all external transactions prior to completing weekly submittals. Creating this behavior ensures that all activity is captured and the team is creating solutions and goals based on recent and accurate financials. Thank you so much for listening to another episode of the Tip Share. We invite you to check out our website, www.rasiusa.com, for more informational and educational resources, and we hope you have a wonderful day.